You are listening to Mining Stock Education.
The two choices are gold and Bitcoin. The governments are not ready to reset the system based on Bitcoin today. It's too small, it's too unproven, it hasn't been around long enough. They don't understand it. It's unlikely that the governments are going to go for a monetary reset with Bitcoin. The governments might go for a monetary reset with gold. Gold is as cheap as $3,000. If you did the 1971 math, to make the amount of gold the U.S. owns balanced with the dollars outstanding, gold would have to be $80,000 an ounce, which shows you how much fiat we've created and how much price suppression there's been.
Welcome to Mining Stock Education. My name is Brian Lenny. Today with me I have Larry Lepard, fund manager and author of The Big Print. In today's show, we are going to discuss his book, why he wrote it, how it can help investors, and Larry's view on the opportunities in the resource sector right now. Larry, it's great to have you. Thanks for coming on the show. Let's start with your book. Yeah, it was an excellent read. I really enjoyed it. Both the historical background and then, yes, I bought the Kindle version.
Okay.
I can't necessarily show it as well as that, but I really enjoyed it. The historical background and then how you got into how we can fix it moving forward, and the idea of sound money, which is such an important topic, I think, for everybody. So let's start off with why you wrote the book. Why now?
Yeah, thank you, Brian. So it's funny, I've told this story a couple times, but basically last year at some point in time, I was watching the presidential election, last year in the United States, and I was watching, this is probably April or May, some sort of a debate or a conversation on one of the channels about, Team Blue and Team Red. And they were arguing very vociferously with each other and yelling at each other and all this stuff. And I just had this moment of insight where I was like, God damn, these people are just arguing about all the wrong stuff. They're so mad and they're so, convinced that they're right and the other side's wrong. And they're not even talking about the one major issue, which is the fact that the money is broken. And the comparison I've used for other people talking about is to say, it's like, the house is burning down and they were arguing about the color of the drapes. You know what I mean? And so I thought to myself, there've been some pretty good books written on this topic, but I couldn't think of one that really kind of addressed how do you explain to the average American or really citizen of the world, somebody without a monetary background, somebody not knowledgeable in gold and silver or Bitcoin or any kind of sound money stuff. How do you explain to them that the problem isn't what these people are arguing about, but the problem really is that we don't have sound money? And so I said, somebody ought to write a book about that. So I started kind of outlining it, and before I knew it, I was writing a chapter and then off to the races. And my next 6 months got, messed up. And my wife says she's a book widow because, and I wanted to get it written quickly because things were changing quickly, and I thought the message is important that people hear it. So from May until December 31, when I finished it, I was kind of heads down writing the story of why sound money is important, why the system as it now exists is broken, and then what we can all do to fix it, by migrating toward, forms of sound money. So the first half is the problem, and I don't think most people really understand the problem or have read about the problem or heard about the problem because they don't operate in this area, and I've been operating in this area for 40 years. But I wanted to put it in terms that anyone could understand. I didn't want to make it a textbook. I wanted to make it lively. I wanted to put personal stories in there because people don't read textbooks, right? People don't read books in general, but they definitely don't read books if they're dull. So I tried to kind of make it spicy. And so the first half was, okay, here's what's wrong. And then the second half is, all right, well, here's what we got to do to fix it. And collectively as a society, we've got to migrate towards forms of sound money. And here's how we do that. So it was really a two-part book meant to, I'll be very satisfied if we're able to get it to go to average people who aren't normally looking at this area, and they read it and they have a aha moment. And they go, oh, wow, I see your point. That's what I want to have happen. So that was kind of the goal.
Right. Well, I think those personal touches were actually what I enjoyed the most. You talking about your past career, and actually, I've got a question that relates to a quote you had from one of your first boss, and it really stuck out to me because the experiences you have in life really show how you experience it and your viewpoints. So I thought that was excellent. So let's talk about what you think is the solution, because I think that's what most people are interested in.
Sure.
You talked about gold, you talked about Bitcoin. So can you sort of encapsulate what you think that solution is?
Yeah. So in general, I mean, it involves just covering the problem a little bit first. I mean, the problem is that GDP is growing slower than debt. Debt continues to get bigger and bigger, and eventually that becomes unsustainable. And then they're going to have to print a ton of money. And the underlying problem that the book talks about, Brian, is inflation, and that we've got a system that requires inflation, and it actually requires increasingly worse inflation, as one of the quotes in the book talks about. And so, and inflation, hurts the average person. I mean, the people who are wealthy, who have assets, who know how to borrow cheaply and invest in good things, they get richer. And the book points this out, in the beginning. I mean, 1% of the country owns 92% of the wealth. Really unfair. The working man, he doesn't really have assets. He doesn't necessarily know how to play the game. He can't borrow cheaply. He gets screwed. And so, and it's all because of inflation, and the inflation is all because of the money printing. And it's not greedy corporations. It's the Federal Reserve and the monetary system that we have that's been set up to benefit them and the people who, are on that side of the ledger. So what's important in history, and what history shows through many examples, is that having a sound monetary unit, which is to say a unit that does not change in relative value very much over time, allows people to coordinate with one another in a more effective means, and prevents bubbles and busts. And therefore, there's greater overall prosperity because of, productivity and efficiency. So, and historically, that sound monetary unit was gold, because it was the soundest form of money we ever had. Been around 5,000 years. Supply only grows at 1.7%. And up until 1971, we're still on a quasi version of a gold standard, not the old classical gold standard, but at least the gold exchange standard. It kind of somewhat constrained money printing, didn't perfectly, but it held it back a bit. Post 1971, then all bets were off, and it's only gotten worse, as the book shows, the chart shows. And so, if we really, the solution that you alluded to, if we really want to go back to a productive, fair society, in my opinion, the book advocates for, talks about, and shows why, we need to return to a base layer of money that is sound. And the two natural choices are gold and Bitcoin, and there are positives and negatives to both of them. And it's unclear which one will be selected. Probably gold gets selected first, and then ultimately I think we go to Bitcoin, because we live in a digital age and gold is analog and it's harder to verify and so forth. But they both have merit, and they're both sounder than fiat by a large measure. And so, the bad news on the, is that the money is broken, and the first half talks about that. And my objective there is actually to get people kind of angry so that they realize, hey, I've been screwed. But the positive news is that technology and developments and the things that are going on in the world are leading us to a system where the money won't be broken anymore, in my opinion. And once that happens, things will be very good again, very much the way they were more in my youth. But there's going to be a transition period between here and there, and it's, nothing's a straight line, but we're going in the right direction. So that's kind of a big picture context. We can drill down on that if you like.
Yeah. So I guess one of the questions, and maybe you sort of answered it there, is what's that catalyst to kind of push us toward making a change? Because, after the 2008 crisis, and that's when I basically was getting out of university, getting into the workforce, 2008 happens, and it was this huge eye opener. And it sort of corresponded when I started getting interested in precious metals. And maybe I think too linearly, and I thought, this has got to come crashing down right now, and we have to make a change. It turns out it didn't work out that way. And
you and me both. Yeah, you and me both.
And so I just wonder, it's seemingly the can can be kicked down the road further and further. So I think you mentioned technology being maybe at the forefront of why a change is made. So maybe, can you explain that further?
Yeah, well, we'll get into that, but let's go back to your first point about the 2000. I'm with you. In 2008, this is it. Fiat's dead. We've seen the problem. Look at how they're printing all this money, and yet they changed the rules. They paid interest on excess reserves. They did all kinds of things to hide the inflation at the consumer level and push it into assets. And so they built up the everything bubble that we now live in. And yes, you're right. I mean, they've been pretty good at can kicking, and I was pretty wrong when I thought 2008 was the end. And here we are 16 years later, and we're still dealing with the same problems. However, the problems are getting, the spasms are getting closer together, and the amount of money printing is getting larger with each event. And, the system, I think, is coming to some kind of a conclusion or a denouement within the next, 5 to 10 years at the most, and arguably even shorter. But to address your technology question, the fact that we now have the internet and we now have decentralized information is kind of breaking down. I mean, the book talks about how the world kind of got centralized during the 20th century, right? I mean, scale economies suggested that building big organizations was cheaper than little. The assembly line, Ford, big steel, all that stuff. I mean, the way to make a lot of stuff cheap was to get scale. And what happened is World War II kind of showed us the limits of scale, which is you can get a very centralized world with very centralized groups. And guess what? If a madman gets control of your country, he starts a war that kills 40 million people. And so centralization, while it has its benefits of scale, it has its negatives of, the guy at the top can mess it all up in a big way. And fortunately, the microprocessor and technology, have led to decentralization and are driving that decentralization trend, which is very important. And so we've got an internet now that's disintermediating the mainstream media. We've got guys like you doing podcasts. We've got, guys like Joe Rogan, spreading, information, et cetera. And so, these kinds of things are changing the discourse, and people are getting smarter and smarter about what's really going on. And the same is true with money. I mean, the Fed has always controlled the money supply, and they do it by jacking interest rates up to 20%. Which almost bankrupted my father, or taking them down to 0%, which blows a big bubble. And that's just, it's nuts. I mean, it's the price of money is a price, that should balance savings with investments. People who have savings, they want to get a return. The people who they need money for an investment for a project to make the world a better place, to provide something, productivity wise, they need to borrow from the people with savings. And so those two should agree at a price where the supply of savings equals the demand for investments, and that's the interest rate. As a practical matter, that's not what we've got. We've got this Politburo called the Fed that jacks interest rates up and down, and it leads to all kinds of misallocations and all kinds of economic stupidity. And therefore, we're not as well off as we should be or would be if we had interest rates set by the market. So that's kind of the fundamental thesis of the book, that we need to go back to a market-based pricing of money, and that to do that, we need to get the money out of the hands of government. And so the two forms of money that the government really can't control, although they've been pretty good at suppressing the gold price, are gold and Bitcoin, because they are money outside of, the government can't print gold, and the government can't print Bitcoin. The Bitcoin is an algorithm, gold is a mineral, it's limited in supply in the Earth's crust, and so there's a natural limit on how much inflation we can have in those two assets.
Yeah, and it's interesting you bring up World War II. Like many would say that the Weimar Republic, the hyperinflation that the Germans
Yes.
that suffered through, is what brought Hitler to power. And
exactly, it is.
And so I think you're bang on with the sound money being the root of the problem, which is interesting how it parlays to where we are today. So when this would be my view, is that government is the reflection of the people, of society, and no matter,
sadly,
yeah. And so, when you talk about people taking that power away from the government, it has to come from the people. The people have to ask for it or demand it, really. And, your book certainly puts people in the right mindset. But I wonder too, if things unfortunately need to crumble for it to come.
Well, that's right, and that's the sad part. I mean, look, the enlightened. I mean, if somebody made me king or president or whatever, I would say, hey guys, we got in fact, I put a presidential speech in the book, right? Say, hey guys, we got too much debt, and that's a problem, and we followed the wrong model, which is Keynesianism, and that's a problem. And what we need to do is restructure the monetary system and use sound money as the base layer. That's pretty simple. We should do that. Now, the odds of that happening today, sadly, are pretty low, because most politicians aren't enlightened enough to understand that. And most politicians really generally only react to something that either get them reelected or prevent them from getting reelected. And usually what might prevent them from getting reelected is severe pain in the economy. And so sadly, yes, as you point out, it might require, economic pain to get people to suddenly focus more on the sound money issue, and then elect politicians that would, focus on it and fix it. And again, part of the reason for the book is, I mean, you understand sound money. I understand sound money. There's a whole community of us that understand sound money. But what are we? Maybe 5% of the population tops? I don't know. Certainly not that percent. We used to be 1%, but it's getting bigger. We're growing because the problems are getting more acute. Well, we need to get half the population to understand that this is the issue. And then, of course, what will happen is politicians who will emerge will say, hey, look at that half of voting bloc. They want sound money. Guess what? I'm a sound money politician because that's what got me elected. And so that's kind of the way it's got to go. Now, I think sadly to get to that stage, unless my book catches on and we sell millions of copies and everyone reads it and the world comes to the same conclusion I've come to, which is probably unlikely, to get to that stage is going to, as you describe, it's going to take more pain. But maybe not as much as you think. I mean, I think if we have a severe economic downturn and inflation continues to go up, that's the dreaded, stagflation, where both sides aren't working. The economy is not working, people are unemployed, and costs are going up. Boy, that's really bad. And my sense is if things get really bad, then people will start, asking around and saying, what the hell's the problem here? And then maybe someone will read my book, or some politician will read my book, or one of these big, voices will get out there and say, you should read this book, and we'll get a movement going, right? And there'll actually be thousands and thousands of people, maybe even millions of people who are like, God damn it, let's return to sound money. So that's, I know that's arguably naive and I'm dreaming, but I don't think it's impossible. And certainly over a longer time frame, I think it's likely, because I think as the problem becomes more apparent, more people will understand it and want that, right? So therein the reason for writing the book.
What's your view on CBDCs? There was there's a lot of talk. If you go back, we're probably about 5 years around COVID, there was a lot of talk about, CBDCs. It's sort of linked up with this narrative surrounding cryptocurrencies, Bitcoin. And to me, like, the first thing that jumps to my head is like when we start talking about Bitcoin adoption, it's like, what? With how governments around the world have wanted to control everything, it would seem that, the crypto craze would definitely fit in with where we're headed digitally. But it seems like they'd want to maintain control. So what do you think about CBDCs?
Well, they do. So yes, I mean, in the Lagarde and the European Union, they've talked about doing their own CBDC, and they would like to do it. And I think there's no doubt they would have tried to do it here, but a lot of us lobbied, and a lot of politicians here have come to understand that it's dangerous. I mean, for those who don't know, a CBDC is a central bank digital currency, which means that, they would create a Bitcoin Me Too. And it wouldn't really be a Bitcoin Me Too because they would control it, but they would create a cryptocurrency that they control, that they can then determine who gets it, how you spend it. They can prevent you from doing certain things. It's Orwellian. It's very much a system of controlling the money through the central bank. And I think it would be horrible if we ever got one of those. Fortunately, I don't see much effort in the US to do it anymore, although, in Europe, they have talked about doing it. But CBDCs are a bad idea, and I'll leave it at that. And Bitcoin is not a CBDC, not even anything close to it. So it's very much a different beast.
So let's talk about Bitcoin further. Let's talk about that best case scenario. We know sound money. So what is it about Bitcoin that you think separates it from the rest of the cryptos out there, and why it'd be a good choice?
Yeah, you've raised a really, really important point, and that one that a lot of gold people and a lot of people just in general miss, and that is the damn cryptocurrency game has really distorted and messed up the signal associated with Bitcoin. So Bitcoin is, let's just go back to basics. Bitcoin is a technological innovation. They solved a problem that had not been solved by computer science for a number of years. There were a lot of attempts, all of which failed because they didn't have all the pieces put together, the cryptography, the hashing, the difficulty adjustment, etc. And when they solved it, what they created was an immutable distributed system of digital scarcity, such that there will only ever be 21 million Bitcoins. And that makes it the only form of money in the history of mankind where there will not be more supply at higher prices. I mean, even gold, dilutes at 1.7% a year. And if the price of gold goes to 10,000, we'll mine more gold, and that 1.7 will go up. Doesn't matter what the price of Bitcoin does, there will only ever be 21 million of them. Okay. Cryptocurrencies are completely different than Bitcoin. And Bitcoin, was grown organically. It started by a person or some people, who named themselves Satoshi Nakamoto. I believe the people who are involved are now deceased. But he launched it into the world, and then he just let people run it. And the only way to earn it was to mine it or to buy and sell it. And it went from being just a curiosity to being a $2 trillion asset class today. All of the other cryptocurrencies are some form of, in my opinion, a pump and dump, which is somebody is the CEO of each of these cryptocurrencies. They create and spin up a cryptocurrency. They give a lot of it to themselves. They sell some of it into the marketplace. They talk up the value of it. That value goes up. And then if they want to, they can sell their own coins into it and they make money. So it's those really very much are like a Ponzi scheme. They are not limited in supply. They can continue to issue new coins. Ethereum, which is the second largest cryptocurrency, has changed its monetary policy 7 times. Bitcoin's monetary policy has never changed. Sadly, these schemes, these what I call shitcoin schemes, cryptocurrency schemes, have cost a lot of people a lot of money. Perfect example being Sam Bankman-Fried, who created the FTX token and spun that up to billions and billions of dollars of value, where at one point he was worth $8 billion on paper, and there was just nothing behind it. And when the buyers stopped showing up, the whole damn thing collapsed, and that's why he's sitting in jail. And so all other crypto, in my opinion, is fraudulent and based on a pump and dump, and Bitcoin is actually a technological innovation. Now, but it's very hard for, the person, people use mental heuristics, right? And so the average person who hasn't taken the time to study this area, they look at it and say, oh yeah, crypto, I know people who lost money in that. That's a fraud. I'm not doing that. And they're right. Crypto is a fraud. But Bitcoin, while it's a cryptocurrency, is actually different than all those other cryptocurrencies. So really important to get that point across. I tried to make that point in the book that, Bitcoin, in my view, is digital gold. It's a cryptocurrency with a limited supply, a fair monetary policy that nobody can game, and, that is non-dilutable beyond the 21 million coins.
And so, what do you think about the Bitcoin's future? Like, if we've seen it go up over $100,000 US. It's come back a little bit now, and I've done some research myself talking about the common points at which you get a pullback. But do you think this ultimately? Obviously, I guess you ultimately think it does keep on going up as it gets. I
do. I think we're still fairly early in the adoption curve, although a lot of people think we're late. They look at people who bought it cheaper and they feel regret that they didn't buy it. But you still are talking about an asset that's only 15 years old, and really the first 5 or 6 almost didn't count because there's almost no tradable market for it. And so, call it maybe 10 years of trading in this currency. It's done extremely well. And my belief is it's going up for the next 40 years, consistently. One way of looking at that to kind of gain a sense of how far it might go is there's a good chart out by a guy named Jesse Meyer where he showed that there are about $900 trillion of assets in the world. And that's defined as cash, stocks, bonds, and real estate. That's worldwide, art and stuff. Worldwide, that's about $900 trillion. Bitcoin's present total market cap is about 1.7 trillion, less than 2. So Bitcoin is less than 0.2% of all of the financial assets in the world. And yet it's the only non-dilutable financial asset. You can issue more bonds, you can issue more stock. Gold is dilutable as we're mining more gold. And so, 0.2% of all the assets in the world, if it went to 2% of all the assets in the world, it would go from, the 100,000 a coin, which is what it was when it was at 2 trillion, to, $1 million a coin. And I think that's going to happen. And there are charts in the book that show, power law and other ways of looking at it. I think that's a very highly likely event that Bitcoin will be at $1 million a coin. It's at 80,000 right now. Now, not tomorrow, and probably 4 to 5 years out. And, 10 or 15 years out, I think it could be at $4 or $5 million a coin. I think it's because we've never seen a financial asset like this before, Brian. The They're a limited supply. So in light of that, its value could kind of continue to go up forever, which is kind of hard to get your arms around. I mean, I think it ultimately will replace fiat currencies, but that's way down the road. I mean, let's just look at it now as a form of digital gold. And that's how I kind of try and explain it to people.
Okay. In your book, you mentioned a statement your first boss made to you, 26.
Yeah.
And he says, this business is a great business. Easy, really. You can only lose 1x your money that you invest, and you can make multiples of the money on the upside. So all you have to do is find the companies with the better than even chance of succeeding, then make the bet. Some will be donuts, but if 50% work out, you get multiples of your money, you'll be rich. So how is this statement does it still ring true with you? And how is that kind of...
Very, very much so. I mean, what he described for me, and I hadn't really thought much about, is asymmetry. An asymmetry of outcomes. And look, I mean, most people in investing are very loss averse, and they're like, well, gosh, I just don't want to put my money in and lose money. But I started off as a venture capitalist, and he was a venture capitalist, and that's where he came in. And so, the whole model of asymmetric investing is you actually have to be comfortable with the possibility that you will be wrong. And I think the other thing that we found humans tend to do is they tend to overestimate their ability to know what's going to happen. You kind of think, oh, I know this is going to work. I know this will happen. And it doesn't. I mean, it just doesn't go the way you think. We've all done that with investments. You made an investment. You're like, oh, yeah. And you're wrong. And guess what? Welcome to being a human. That's just the nature of the game, right? So, but I'm an engineering mind or a mathematical mind in kind of my base layer of thinking. And so, what really appealed to me is what he described was, hey, okay, so we're all going to be wrong sometimes. And okay, fine. Being wrong means you lose all your money. That sucks. But guess what? And he described, by the way, he described the opposite of asymmetry, which is banking, which is a bank, when they make a loan, they can lose all their money, but they can only make like 5 or 10% interest on it. Well, now that's a shitty business, and that's why banks are so careful, because they just can't afford to lose very many because they're not making. So what he opened my mind to was the notion that if you're looking at things where if you're right about what's going to happen, you're making 2 times, 5 times, 10 times, 20 times your money. Okay, well, you can afford to be wrong occasionally. You know what I mean? Okay, I make 3 bets. One of them goes to 0. One of them breaks even, but the third one goes up 4x. Well, you still, on the money you've invested, the 3, you've still got a return. It's not outstanding, but it's not bad. And so that's really what asymmetry is all about. Do you know what I mean? Is finding things with upside, and as a mining guy and a gold stock guy, you understand this, and all gold mining stock investors understand this as well. I mean, any mining company can fail, and God knows plenty of them have. But occasionally, right? And I mean, I found every way to lose money in the mining business possible. It's a hard business. But having said that, if you kind of get the right team and the right geology and the right place and the right time, you pay the right price, boy, I've had things make 10 times, 20 times, 30 times my money. Well, guess what? That makes up for the 1 or 2 times when, or more, but the times you're like, boy, I thought they'd make it and they didn't. That totally didn't work, So that's just, it's asymmetric investing. And it's interesting because that has always been how I approach Bitcoin too. In the early days, I bought just a little of it back in 2013 or 14 at, $400 or something. But I was very worried about the technology. I thought to myself, it's a computer. Computers can fail. It can get hacked. This isn't going to work. And there'd been 5 other experiments that had failed. And this is probably another one of those. But again, back to my asymmetric. But if it does work, it could really be big. Well, I'll buy some. And if I lose, I lose. But if it works, those coins I bought a handful of them, $400 a coin, they're now 80,000. Well, I'm glad I did that. So Bitcoin's got that same kind of asymmetry. In fact, I think it's one of the more asymmetric bets out there right now. I mean, I think gold mining stocks are pretty asymmetric right now too, but it's got just a lot of upside. And could it fail? Sure. Anything can fail. I could be wrong. But, we've now got 16 years of data, 880,000 blocks, a lot of technological, innovation and improvement along the way. And I'm kind of at the stage where I think the odds of failure have gotten fairly low. And I think the odds of continued adoption are pretty high. So to me, it seems like a pretty good bet.
Absolutely. Again, the personal experiences that you link in your book, I think, were phenomenal, and it really helps with the storytelling and keeping the reader focused on the
Well,
book.
thanks.
There's a quote. It's by a guy named Robin Sharma. He wrote the 5 a.m. Club. Then he says, "We only hear what we're ready to hear. All learning meets us exactly where we're at, and as we grow greater, we understand better." And this is something that's rung true so much with me over my life, and what you're talking about, taking calculated risk in your life to make a difference. So I was wondering about your process of learning over your career, how mentors or how your experiences have sort of shaped to where you are today.
Well, it's a great question. I mean, so everywhere I worked, I was always kind of watching for who's the smartest person and what are they doing. you know, and so like that first boss taught me about asymmetry, and then the next set of guys I worked with, they really understood how to find good companies that were, high. They taught me how to assess that probability risk, like get to the point where that chance of a failure, that one, where you're going to lose one, get that down to maybe 20%, chance of loss. And then, then the balance is upside or break even. And, look, doing an investment to break even, that's not the objective, but it's better than a loss. And so those guys kind of taught me that. And the other thing I would say about that asymmetric investing is there were so many times, I said this in the book, where I would look at the analysis of a company. I'd say, okay, you know what? This thing kind of looks like if we buy it at this price and it does what I think it's going to do, we're going to make 3 times our money. And that's a very good return. And you know what would happen? I would, things would go, I mean, occasionally it wouldn't work and I'd lose the money. But all the other times it would be like, oh my God, they did a lot better than I thought. And we didn't just make 3 times, we made 9 times. Well, I didn't do any more work to get the extra 6 times. I just got lucky on, it just fell out on my side of the balance sheet. You see what I'm saying? So that was something I learned there. I just all along the way, I've just kind of been a sponge and just trying to, observe and learn things. I mean, I'll tell you one of the things I learned in the book that I think is an insight from the book, and it kind of blew my mind when it hit me. I was doing all the math and stuff, and near the end, so I was raised, and you probably were too, in traditional investing, traditional metrics, PE ratios and growth and all the normal stuff, ratio to book value, all that kind of stuff. And, like the best investments were companies that ended up being really big leading companies. Like I studied General Motors. It went public in 1916. And, if you held it during the life of it, you'd have made, I don't know, 200-300 times your money, as it grew to become leading auto manufacturer in the U.S., in the 60s. Okay, great. That's great. It's over a long period of time. It's 300-400 extra money. I started studying these networking businesses, and I looked at Facebook, and I looked at Google, and I looked at Amazon, and I looked at, all businesses based on the internet, based on a network on the internet. All right. These businesses in 20 years, Amazon's up 218,000%. Google is up 9,000%. Facebook is up like 3,000%. Okay. In 20 years. So, I described the old model, General Motors, 400x, 400%. 400 times your money, over the course of, 50 years. These are thousands of times your money over the course of 20 years. Something is different in network investing, and it breaks the model. And I missed it because I was looking at Google, and I was looking at Facebook, and I was looking at all these companies when they were coming public, Amazon, when they were early public years. And I looked at 2 things. I looked at the price and I looked at the earnings. A lot of them weren't profitable, so that was a turnoff. I was like, well, you got to buy value, you got to buy a multiple of profits. Well, there are no profits. How do we? And then I looked at even like multiple of sales. Like, Jesus, even by multiple of sales, this thing is insanely priced, right? So I didn't do it. I didn't, I missed it. I just didn't do it. I didn't realize that what they were building was a moat and an unshakable franchise, that there's only going to be one Google. There's only going to be one Amazon. I didn't realize that. I didn't see it. And that's a network investing model based on Metcalfe's law, which says that the value of a network goes up at an exponential rate compared to the growth of the users. So that the more users that grow, it grows. The value of it doesn't just go up the user growth, it goes up a square of the user growth, some higher power of the user growth. I missed that. Well, that model applies to Bitcoin. It's the same model. This is a network. It's a monetary network. And we're still, I mean, survey your friends. How many people do you know own Bitcoin? I mean, it's not, are we at 10% penetration? Probably not. Right. And yet more and more people are coming, and more and more people are going to see the value proposition, and that's going to grow. And so, I went to a gold conference. I spoke at Brian London's gold conference down at New Orleans. And I said, I think Bitcoin's going to be $10 million a coin sometime. And I heard all these scoffs. I mean, people just think I'm nuts, I can't believe he's saying that. What a promoter, da, da, da. I don't think it's hard to get there. I mean, just take it at a compound growth rate, but it's running at today. Now, not tomorrow. I mean, I'm talking in 20 years, but it's going to go up over time consistently.
Let's talk about that other asymmetric bet that you mentioned, the gold market. What do you think of the gold market, the equities? Where's the opportunity?
It's huge. The equities are a huge opportunity right now. And I think a lot of Bitcoiners actually missed this, that gold is going to do very well too. I mean, Bitcoin is going to do better on a price basis compared to gold, but it's more volatile. So the gold market, I mean, the world is in a sovereign debt crisis, in my opinion, based on the government spending too much money and printing money to cover it, and the growth of the debt compared to the GDP being too large. That's all true. Okay. Having said that, the solution to that crisis is return to money the government can't print. The two choices are gold and Bitcoin. The governments are not ready to reset the system based on Bitcoin today. It's too small. It's too unproven. It hasn't been around long enough. They don't understand it. It's unlikely that the governments are going to go for a monetary reset with Bitcoin. The governments might go for a monetary reset with gold. Gold is as cheap as $3,000. If you did the 1971 math, to make the amount of gold the U.S. owns balance with the dollars outstanding, gold would have to be 80,000 an ounce, which shows you how much fiat we've created and how much price suppression there's been. So in a reset, gold is going to go up very substantially. So I believe there's a lot of upside in gold, and I hold a lot of gold. The gold mining stocks, it's even better, because as a result of, the last apocalypse in the gold mining area, which was 2011 to 2015, mining investors have really not returned to the stocks. And one of the things that I find stunning is the way that the gold price has gone up quite a bit and the stock prices just haven't moved yet. And it's because of that skepticism, that historic skepticism. And it's because it's a tough business. I mean, all gold stocks are not alike. The difference between investing in a good gold stock and a bad gold stock is the difference between 5x and -1. And there are a lot of -1s out there, and you got to avoid them. Okay. But there are some 5x's out there, or there's some 20x's out there. And again, it's hard to know the difference between a 5 and a 20, but if you find good people, good project, operating, have positive cash flow, starting another project, the odds are better than average that they're going to make it. And so, yeah, I fully expect in the next few years that gold stocks are going to explode, because one of the things that's held them back. So gold was kind of stuck from the COVID print, which took gold from, I want to say 1360. Well, it was over that before, but gold went up to 2070 on the COVID print. And then it kind of got stuck there from 21, 22, 23. And then last year it broke out at 2070, and it went to, 2300, 2400, 20, and we're now at 3000. But throughout all of that, two things were happening. One, the ASIC, which is the average all-in sustaining cost of mining an ounce, went up because inflation's present, right? Cost of labor, cost of explosive, cost of oil going up. And the second thing that happened is that the analysts, gold analysts on Bloomberg and in Canada mainly, because it's where a lot of the mining takes place, they all said, well, this 2070, it's not going to last. It's going back lower. Or even this 2400, it's not going to last. It's going back lower. They were all looking in the rearview mirror, and they realized that the cost of the ASICs were going up, and that, well, the margins are going down. Why should we own these stocks? I think what's slowly happening right now, and I don't know how much you've been following it, Brian, but I've been following. We're having a very good month in our gold stock fund. They're finally starting to wake up to the fact when gold crossed 3,000, I think a lot of those analysts who were like, okay, it's 2,500, but it's going back down. I think they're now kind of reassessing and going, maybe it's not going back down. Yeah, maybe it's going to stay at least 2,500. And by the way, most gold companies make a lot of money at 2,500. They make insane amounts of money at 3,000. And if you start really thinking, well, gee, it's not only going to not go back to 2,500, it's going to stay at 3,000, or heaven forbid, it's going to go to 3,500 or 4,000. Oh, dear God, are these stocks cheap, right? And so I think we're in the situation, the process right now of that mindset changing from gold is overpriced and going back down to, oh, maybe we've got a sovereign debt problem. And maybe, I mean, we're seeing, as you know, and I'm sure many of the listeners know, we're seeing a lot of gold being shipped from, Switzerland and England back here. We're seeing shortages in various things and so forth. So, we're seeing central banks buying remain very, very strong. And I think a lot of people are kind of starting to get the whiff of, oh my goodness, maybe this is really going to be a pretty big run. And I personally think we're going to go to 5,000 or 10,000, in the next several years. And I can tell you, if that's the case, given, the mining companies that I own, given how profitable they are, even at 2,800, it's going to get nutty if those kinds of numbers come to fruition. But, I mean, right now, actually, it's the price of the gold itself is a little bit out on a stick. I mean, it's run pretty hard at 3,000, and it feels a little overbought to me right here. And it could easily come back to 28 or 27. But you know what? I mean, I've got companies that are building their models on 2,200. So even at 27 or 28, they're gonna be doing just fine. Thank you very much. So, nothing ever runs in a straight line. But the point, I think, is that based on government behavior, based on the deficits we're running, based on the money that I think is going to need to be printed, and of course the book is called The Big Print, talks about how I think that's coming in the future. Based on those things, gold is smelling it, and that's why gold is doing what it's doing. So.
Right. Are there any companies that you could share with us that have caught your eye?
Sure. Yeah, no, I'd be happy to. So let me just describe the sweet spot. The sweet spot, in my opinion, in the gold mining universe is to find a company that has production, to find a company that is cash flow positive, to find a company that sells at a reasonable multiple of that cash flow, and to find a company that's not enormous, because and has a pipeline of new projects coming online so that they'll be able to grow. So that company makes money three ways. They make money if the price of gold goes up compared to the cost of mining it. They make money as their multiple expands. I mean, I've got companies I'm buying that are 3 or 4 times cash flow. They'll someday trade at 8 times cash flow. So no difference in cash flow. They might double in value. And they make money if they bring a new mine online, and that produces more gold. In the majors, probably my favorite is Agnico. It's the high quality, leader in all respects. And if I had to pick just one major, that'd probably be the one I'd own. It's not cheap, but rightly so. There are a lot of other majors below that I like, including Kinross and a few others. Alamos is good. But, those are big and safe, and, they're not going to go up 5x. In the smaller names, they're riskier, but some of them are going to go up 5 or 10x. I mean, there's a silver miner called Avino that I like a lot. It's one of our biggest positions. It's just gone up a lot, but if they're able to execute on their growth, it's got a lot further to run. I like B2 a lot. We own a lot of that. I've got 30, 40 companies in my portfolio. There's one over in West Africa that's got a West Africa penalty on it, but it's incredibly cheap, called Orezone. I like that a lot. There's some drill stories that are incredibly cheap, like Banyan, which I own a lot of. But the drill story and the developer business they're tough businesses. I mean, developers are guys who have a deposit, they're trying to build a mine. Hard to do, costs more, takes longer, regulatory risk, et cetera, et cetera. I've got some of those, but that's not as much as the producers. Drill stories, same thing. You're depending on geology and geologists. I love Lavras. I'm on the board of that. It's a great drill story. I think it's worth a lot more than its price for Flex today. I mentioned Banyan. We were big holders of Collective, which has had a huge run. It's a great drill story. But I would caution people that going into this area, there are a lot of guys, that it's the old Mark Twain the gold miner is a liar standing on top of a hole in the ground. I mean, and I'm not trying to malign the whole industry, but, not every company makes it. There are a lot of minus ones, and, it's extremely important to trend toward quality, because, then you avoid the minus one. Now, the higher the quality you go, it's in the price. And so, like I say, it's going to take a lot of movement to get Agnico to be a 5 or a 10 bagger, but you're not going to get hurt owning Agnico if you want to buy one gold miner. So,
right. Larry, where can people buy your book?
Oh, absolutely. Thank you so much for that. So it's on Amazon. You can buy a hard copy, paper copy, EPUB, Kindle copy in about a week. I think next week we will be launching the audio version, which will have a slide deck as well, a PDF slide deck. It's the kind of book, actually, it's better to have it paper because there are a lot of charts in it and slides in it. But you could, listen to it audio. It's 13 and a half hours long of audio. Got a great guy reading it named Walker. I'm also on Twitter under my name, Lawrence Lepard. I make a lot of noise. I criticize the central banks. We're trying to recruit a sound money army here, Brian. I want, in my opinion, the reason I wrote the book, it's the problem of our age. And if we want to get rid of a lot of the problems we're facing and the dysfunction that we're encountering, if we can get back to a sound money standard, I think things will get a lot better. So, that's kind of why I do what I do. So
Excellent. Well, I completely agree with you, Larry. I've really enjoyed the chat today. Like Larry said, we're going to link to the book, link down in the bottom, and really enjoyed the chat. Hopefully we can do it again soon.
Okay. Sounds great, Brian. I'm happy to do that.